Unlock the secrets to building lasting wealth, not just for yourself, but for future generations, by mastering the art of raising and deploying capital effectively. This isn't just about funding a business, it's about strategic financial architecture. Generational wealth is more than just money in the bank. It's assets, knowledge, and values passed down. It provides financial security and opportunity for your family's future. Building it requires a long-term perspective. It involves strategic decisions today that compound over decades. This applies whether you're a founder or an investor. For founders, it's about building a valuable asset, the company. For investors, it's about wisely deploying capital into high-growth opportunities. Both paths can lead to significant wealth. Raising capital isn't just survival, it's leverage. It allows you to accelerate growth far beyond what bootstrapping permits. This speed is key to increasing company value rapidly. Each funding round, if executed well, should increase your equity's value. You sell a piece for more, validating and growing the worth of the pieces you keep. This is direct wealth creation. Strategic use of funds is critical. Invest in growth drivers like talent, technology, and market expansion. These investments fuel valuation increases. Understand dilution, but don't fear it. A smaller percentage of a much larger pie is significantly more valuable than 100% of a tiny one. Focus on growing the pie. Plan your equity structure carefully from day one. Use stock options for employees to align incentives. This builds a team invested in the company's success and value. Consider secondary sales opportunities in later rounds. This allows founders and early employees to realize some liquidity without exiting the company entirely. It's a wealth-building milestone. Ultimately, the exit, IPO, or acquisition is the primary wealth event for founders. Building a highly valuable, desirable company through smart fundraising and execution is the goal. For investors, allocating capital to startups offers asymmetric returns potential. A single successful investment can offset many others and generate substantial wealth. Due diligence is paramount. Understand the market, the team, the technology, and the business model. Invest in founders with vision and execution capability. Diversification is crucial in startup investing. Not every venture will succeed. Spreading investments across different companies and sectors mitigates risk. Invest with a long-term horizon. Startup growth takes time. Be prepared for a multi-year journey before seeing significant returns or liquidity events. Understand the funding stages. Investing early, seed, Series A, offers higher potential returns but also higher risk. Later stages, Series B, C+, may have lower multiples but are more de-risked. Consider fund investments as an alternative. Investing in a venture capital fund provides diversification and professional management, accessing deals you might not find alone. Align your investment strategy with your overall financial plan. Startup investments are illiquid and high risk. They should be part of a broader, balanced portfolio. Look for companies solving real problems with scalable solutions. These are the businesses most likely to achieve significant growth and provide strong investor returns. Whether founder or investor, integrate startup activities into your holistic financial plan. This includes understanding tax implications of equity, gains, and exits. Work with financial advisors experienced in illiquid assets and startup equity. They can help plan for taxes, diversification post-exit, and wealth transfer strategies. For founders, manage personal finances alongside company growth. Don't neglect personal savings or investments outside the startup, especially in the early, lean years. For investors, track your portfolio performance diligently. Rebalance your overall asset allocation as needed, especially after significant liquidity events from successful startups. Consider establishing trusts or other structures for wealth transfer. Planning early ensures your generational wealth goals are met efficiently and effectively. Educate your family about financial literacy and the value of the assets you are building. Generational wealth includes passing on knowledge, not just money. Reinvest returns wisely. Successful exits or dividends can be reinvested into other opportunities, further compounding your wealth over time. Maintain a clear picture of your net worth, including illiquid startup equity. This helps in making informed financial decisions for the future. Generational wealth through startups is often a collaborative effort. Founders build the value, investors provide the fuel. Their interests, when aligned, create powerful synergy. Investors provide not just capital, but often valuable expertise and network connections. Founders leverage these resources to accelerate growth and navigate challenges. Clear communication and transparency build trust. This relationship is key to navigating the ups and downs inherent in the startup journey. Celebrate milestones together. Each funding round, product launch, or growth metric achieved is a step towards shared success and increased value for all. Plan for potential exit scenarios collaboratively. Understanding investor expectations and founder goals helps align strategies for the most beneficial outcome. This partnership, built on mutual respect and shared vision, is a powerful engine for creating significant, lasting wealth for everyone involved. It's about more than just a transaction. It's about a shared journey towards building something valuable and enduring. For founders, avoid excessive dilution in early rounds. Understand valuation metrics and negotiate effectively to protect your equity stake. Don't raise money without a clear plan for its use. Wasted capital doesn't drive value and makes future fundraising harder. For investors, avoid investing based purely on hype or FOMO. Stick to your due diligence process and investment thesis. Don't over-allocate to a single startup, no matter how promising. Concentration risk can be devastating if that one venture fails. Both parties should avoid misaligned expectations regarding valuation, control, and exit timelines. Clear agreements are essential. Neglecting legal and financial documentation is a major risk. Ensure all agreements are clear, fair, and legally sound. Failing to adapt to market changes or competitive pressures can derail even promising ventures. Stay agile and responsive. Ignoring the importance of team and culture. A strong team is fundamental to execution and long-term success. Founders, refine your business plan and financial model. Understand your valuation and practice your pitch. Identify target investors who align with your vision and sector. Investors, define your investment thesis and risk tolerance. Build your network to access deal flow. Develop a robust due diligence framework. Both, commit to continuous learning about markets, technology, and finance. Seek mentorship and expert advice. Build relationships based on trust and shared goals. Start planning your financial future today. Whether raising or investing, approach it strategically, patiently, and with a focus on building enduring value.